Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Hello everyone, my name's Manpreet and welcome to Through the Noise. Now it's less than 10 days to Trump's inauguration as the 47th US president. Markets are already showing some signs of concern on what kind of impact his policies are likely to have on the economy, with a particular focus on tariffs and their potentially inflationary impact, which is, of course, proving to be most visible in bond yields and the US dollar, where we've seen a rise across both in recent weeks. Now, how should investors consider positioning ahead of his inauguration, given his policy proposals, but also the longer-term economic and earnings fundamentals? To discuss that question and much more, today I'm happy to be joined by Fook Hien, who's a senior investment strategist in the CIO office. Welcome, Fook Hien. Thanks for joining us in the first podcast of 2025. Let's get straight to Trump's inauguration as we count down to that 20th January date. In your view, how should investors be positioning their portfolios?
Thanks, Manpreet. So since Trump's election in November, the US dollar and US equities have performed well, and we expect this to continue. However, this week's market volatility, as investors second-guess Trump's policies, it is a likely precursor to the coming weeks. We expect more speculation about the incoming Trump administration's policies on trade, immigration, tax, and deregulation. So a Washington Post report this week was suggesting Trump's team plans to water down his tariff proposals, and this dragged the US dollar and bond yields briefly lower before Trump denied any such plans, leading to a bounce back in yields and the US dollar. And this was followed by a CNN report which said that Trump is considering declaration of a national economic emergency to introduce universal import tariffs. So against this backdrop and volatility, maintaining a diversified allocation is a time-tested way of riding out volatility. Within that, we have a preference for US equities and high-yield bonds. And in addition, we would take advantage of the bond market volatility to lock in attractive income for the long term. Gold also remains an investor's best friend, given the looming geopolitical risk.
Okay, so thanks for that. Maybe just diving a little bit deeper on Trump's policy agenda. I mean, what would be the specific aspects of his policies that you believe investors should watch out for? And I suppose the second part of that question is, how would you balance that against, the economic data and what specifically to watch out for over there?
For Trump's policies, we would watch the sequencing of policy. As Trump takes charge, we expect more clarity on the scale of his proposed tariffs and their timing, duration, and target in terms of goods and countries. And this will help to assess their impact on inflation and growth. We expect any tariffs to be phased in, leading to a temporary pickup in inflation. However, negotiations with trade partners are likely to be contentious, with potential for retaliation, which will add to market volatility. We also expect Trump's plans for mass deportations to face legal challenges. But on the positive side, the size and scope of his tax cut and deregulation plans and the streamlining of government expenses, this will determine the impact on budget deficits. We expect that Trump to be ultimately responsive to the feedback from markets, and this will help to moderate any extreme measures. And yes, besides Trump's policies, it is important to keep monitoring the jobs and inflation data. Money markets, they have pushed back expectations of the first Fed rate cut to June from March. There was an expectation at the start of December last year. So this is partly due to concerns about the inflationary impact of Trump's policies and the still robust US economic data. And we also saw the Fed minutes from its December meeting showed that the most members agreed that upside risk to inflation has increased because of Trump's proposed policies. The next two key data points are one, US jobs data on Friday, the 10th of January. A consensus is for 165,000 jobs added to the non-farm payrolls. And the second is the inflation report on the 15th of January, where consensus is for core CPI of 0.2% month-on-month or plus 3.3% year-on-year. So if the jobs and inflation data come out stronger than expected, these are likely to drive bond yields and the US dollar higher because your US interest rate differentials with trade partners will widen, and this could potentially lead to a pullback in equity markets.
Thanks, Fook Hien. I guess a good time to talk about bond yields, maybe extend that last point you made a little bit further. US bond yields have already been moving higher in recent weeks, so do you expect them to move further higher still?
Yeah, we see an opportunity here really to take advantage of bond volatility to lock in the elevated yields. The US 10-year government bond yield has surged since the election. And on the policy side, announcements from the Trump could keep inflation expectations elevated. But technically, it is approaching a key resistance around 4.74%. And while the yield could still break higher towards a 2023 high of 5%, we see an opportunity now for investors to lock in the elevated rates to secure long-term income. And besides US government bonds, your US mortgage-backed bonds, global convertible bonds, and European government bonds hedging the FX, these offer additional opportunities for a pickup in yield.
Okay, maybe let's move to equities. We're almost at the next, U.S. earnings season. So, what are you expecting from that, and how does that play into your sector preferences?
Yeah, the Q4 earnings season in the US will kick off with the major banks reporting from the 15th of January. So the S&P 500's Q4 earnings growth is expected to be at 9.6%, which is rising from the Q3 level of 9.1%. This acceleration is expected to continue in the quarters ahead, rising to 12 to 13%. And this is based on LSEG's IB's consensus estimates. So besides the Q4 earnings beats or misses, we will watch for how corporate guidance shapes the consensus expectations for 2025. We will watch for any signs of consumer weakness, the impact of the Fed's rate cutting cycle, and the ongoing investments into AI. The consensus expectation is for 2025 earnings growth of 14%, which is up from 2024 earnings growth of 10.1%. In 2025, all sectors are expected to deliver positive earnings growth led by technology and healthcare sectors. The strong earnings growth, this underpins our expectation for US equities to outperform global equities. Our preferred US sectors over the next 6 to 12 months are technology, communication services, and financials. Technology's leading earnings growth is attractive to us, with the growth likely led by AI applications and investments. Communication services, they also enjoy strong growth via online entertainment and reasonable valuations. And finally, financials, they should be boosted by deregulatory tailwinds.
Okay, maybe shifting gears a little bit to China. We had the announcement that the US is adding a list of stocks to their own list of companies linked to the Chinese military. What do you see as the implications of that move?
Yeah, the US Department of Defense, they added China's leading technology and battery stocks into a Pentagon blacklist. The detail is section 1260H if you're interested. This was added on the 6th of January. So the near term, we believe this move will dampen investor sentiment towards Hong Kong and China equities. But looking beyond this immediate impact, the blacklist is unlikely to have a long-term impact on the stock fundamentals in our view. Unlike sanction lists, this 1260H, this blacklist I'm talking about, it serves as an advisory purpose and does not impose legal bans on business activities. US investors are also allowed to invest in these stocks. Now, the risk, of course, is that these blacklisted companies could potentially subsequently be added to sanction lists. And this could trigger tangible investment restrictions, such as removal from benchmark indices, which should cause selling by US funds. So worries of such a scenario and potential retaliatory measures, they are likely to remain an overhang on China and Hong Kong equities. We stay neutral on China equities within Asia ex-Japan. We prefer onshore China equities over offshore because the onshore China equities, they're relatively insulated from geopolitical tensions and they are more direct beneficiaries of China's potential policy stimulus.
Okay, and finally, just a quick question on the renminbi. We've seen dollar CNH, rise and the currency weaken. Hence, in the last few months, do you see dollar CNH rising above 7.4?
Yeah, we expect the dollar CNH to be range bound in the near term. The widening spread between US and Chinese government bonds have been a key driver, but China's 10-year bond yields fell to a record low amid concerns over the pace of economic recovery and the policy easing. This yield, though, has stabilized around 1.6% in recent days, and heightened policymaker scrutiny raises the risk of intervention to limit currency volatility. So together, these are likely to help anchor the CNH. From a technical perspective, dollar CNH appears overbought with resistance levels near the previous highs. And so together with policy signaling, this is likely to cap the dollar CNH. And we expect the pair to trade within 7.269 to 7.375 range over the next 1 to 3 months. The key focus next week will be on China's GDP and industrial production data.
Okay, I think that brings us to the end of the time available, so we'll bring the conversation to an end. Thanks, Fook Hien, for sharing your insights today. If I can share the top 3 takeaways. Number 1, some concerns about upcoming volatility, but diversification, of course, a time-tested way to ride out short-lived bouts of volatility. Second is, let's not forget to use any rebounds in bond yields to lock in long-term income. And third, just going into the US earnings season, a good time to remind ourselves that is technology, communication services, and financials are our preferred sectors in US equities. So with that, we'll bring today's podcast to a close. Thanks very much for listening into today's podcast, and we look forward to speaking with you again next week.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details, visit Market Views on the Go on our website or click the link in the description.